Good to be back. Ed Ponsi here, your FX educator, here on behalf of FX Street once again. Hey, hope you're doing great. Here we go. We rounded up a lot of strong economic data out of the U.S. about a half hour ago. Let's take a look at some of the charts and see how some of the reactions are going. Our little trade still continues on here. We'll come back to this in a minute. But first of all, let's take a look at the dollar index. I want to go back to the daily charts, right? We always want to see the forest for the trees, right? So DXY, the dollar falling on strong economic data. That certainly seems to be counterintuitive, doesn't it? But you look at the rally it's had since the beginning of the month. It's really had a tremendous run. Was some of this data already priced in? I don't know, but this movement does seem to support the thesis that we could be looking at a rather large head and shoulders on the dollar index. And this is one more candle closer to bringing that to a reality. I don't know how this is going to wind up. I probably shouldn't be drawing this yet because it's too soon, right? It's too soon. But as I draw that up, that's in my imagination, kind of looks like this, that this is where we're heading. And of course, so the U.S. dollar has been pretty strong recently, maybe one of the stronger currencies, especially due to euro weakness. There's a lot going on in Europe. There's a lot of elections coming up. We could see some shocks. We could see some shocks in France and some other countries, Italy, and Denmark. So there are elections coming up, and this could create more turmoil in the European Union. Markets just hate uncertainty. They just hate uncertainty. And but the euro having a good day today, I would imagine if the dollar is down, then Euro USD is probably green. There it is, right? And this is also developing into a potential inverted head and shoulders, and we're one candle closer after, with today's candle. Should it stay that way? We really have no idea if it will, but we appear to be one candle closer to this being a reality as well. That's pretty big pattern. Using a measuring technique, this would probably pop you, if it goes from 104 to 108, that means 108 to 112. That might be a little bit aggressive, gang. I don't know if I'm going to say 112, but, anything's possible in this game. And it's counterintuitive that the dollar would fall on strong economic data. That's something that always catches my attention, right? Because everything that happened this morning says rate hike, doesn't it? Isn't it true that pretty much everything we saw this morning, right? Jobless claims strong, Philly Fed very strong, housing starts and building permits stronger than expected. All of these things point toward a rate hike. And yet the dollar is falling on this news. Interesting, right? So, hey, what does it mean? Who knows? Maybe somebody just needed to sell dollars today, or maybe somebody decided to, buy the rumor and sell the news, right? So maybe that's it. I don't know. We can't know everything, right? But that chart looks a little bit ominous. If the dollar is down, gold is probably higher, and there it is, a little bit higher. Gold's been good. I mean, it's gone up 100 points, and I don't think I was here to discuss it because I was probably in the hospital, but right near the end of the year, there was a really nice crossover on MACD down here, right there. And yeah, these are like it's a trending indicator, so you don't want to take signals that go against the trend. This is trending up quite nicely. I still think it could go to 13. I'm looking at this area here as being kind of noisy. This was the election area. Maybe 1280 to 13 area looks like it could be good for resistance. There's definitely pockets of resistance in here. So, but you know, you've got to say the chart's pretty bullish. Higher lows, higher highs in here, right? These are your higher lows right down here. And these are your higher highs right up here. Okay, so there we go, right? That's, do you think the markets aren't buying 3 hikes this year? Sandy, this is a great question. The way the data is coming out, I don't think it's out of the question. You know, last year, economic data just could not get any traction. You'd get a good number and a bad number and a good number and a bad number, and it would all add up to nothing. But today we saw everything was stronger than expected in here, except for continuing jobless claims. Everything was better than expected, and some of it was way better than expected, right? And that's just today. And if you go back to earlier this week, right? If you go back to here, just look at this week, right? Look at some of the other stuff that came out. I'm just talking about the U.S. here. So let me just sift through this. Producer prices jumped on Tuesday, right? Jumped. 0.4 looking for 0.2. 0.6 looking for 0.3. Those are the monthly figures. These ones that beat by 1/10, they're year over year. So everything's kind of smoothed out. But the monthly figures jumped, and that's telling me something's happening right now. And if I look further, right, at consumer price index, I see the same thing. The monthly number jumps consumer price index. Oh, and retail sales jumped better than expected. Empire State yesterday, better than expected. Just like Philly Fed was better than expected today, Empire State is similar to Philly Fed, right? These are both Fed surveys for local areas. For New York, it's upstate, Rochester, Syracuse, all those factory towns, right? And for Philly, it's like the Philadelphia region, Philadelphia, New York, Delaware. But my point is, better, just every piece of data is coming out better than expected all of a sudden. Not every single one, but man, the vast majority are coming out better than expected. So I would say 3 rate hikes is definitely possible this year. Plus, one of the things you may have noticed this week is that, you know, with Yellen appearing on Capitol Hill, Yellen is very much at odds with Mr. Trump and with the Republicans, and she's made it very, very clear that she is going to stick around until the end of her term. So maybe, maybe she's serious about raising rates, just, because she's going to do what she thinks is right, regardless of what anyone's trying to tell. So I think 3 is a distinct possibility. I think 3 sounds about right, based on what we're seeing. And I think we could see one soon, like March. I think you're going to see one very soon. So this is happening, right? And, if you had asked me that even a week ago, I might have been a bit more skeptical. But when you see all the numbers hitting, or almost all the numbers coming in better than expected, and some of them are way better than expected, whenever you see that, that's saying economy is recovering, just from my personal anecdotal experience. And when they're all missing, when they all come out bad, that's telling you the economy is getting weaker. So I think they're going to need higher interest rates in the U.S. I think it's going to be a necessity. Now, so gold looks good, and gold is a hedge against inflation. And probably one of the more interesting charts is we'll look at copper later, but is oil. Now, oil's hanging in there. And so you're going to say, well, Ed, that's a very boring chart. Yes, it is. But the interesting thing is that the price of oil is holding up despite the fact that there's really been a big buildup in crude oil inventories. Usually that pushes prices down. We know that OPEC has made cuts, but there's plenty of inventory. And so the price is not rising due to the OPEC cuts, and it's not falling due to the builds in inventory. It's just kind of hanging in the middle, waiting to see what happens. Fascinating stuff. One of the things about oil that I find very interesting is it is fungible. What does that mean? That means if country A cuts supply and country B raises supply, I'm sorry, if country A cuts production and country B raises production, then the net effect is no change in price. It doesn't matter where the oil comes from. It just matters whether or not it's coming. So really, by OPEC cutting production, they're really just seeing an added production from the U.S., and that's why you're seeing oil inventory builds. They're just going to lose market share to the U.S. It's kind of interesting and endlessly fascinating. But U.S. oil production is increasing again. It pulled back when oil got down into the 30s and in the 40s because these companies can't make money down there. But you put it up in the 50s for an extended period of time, suddenly they start bringing that oil out of the ground again. Okay. The only thing is wages as January year over year were flat, plus oil recovery helped higher CPI. Okay, fair enough. Fair enough on CPI. But if you take oil out, right? If you took oil out of CPI, I think it still looks pretty good, right? So this is CPI beats by 0.3. But if you go X food and energy, okay, it still beats, but only by 0.1. So Sandy, probably onto something there. A lot of that was oil. Okay. As far as year over year wages, though, I will say this. I think the next year of wages might look very different from the previous year of wages, just based on the way things are going. Like we said, a lot of these numbers are coming out better than expected all of a sudden, but there are also going to be policies put into effect that are not into effect yet. One of them is going to be reduced regulation. Now, I'm not telling you that it's good. I'm not telling you that it's bad. Here's what from my personal experience, I work in the Forex industry, not just as an instructor, right here, but also as a trader. And I've also traded other people's accounts. And so I've dealt with the CFTC and the NFA quite a bit. Not because I did anything wrong, but because they began to overregulate the industry and drive everybody out of the industry, including me. I made money from my clients. And at one point, at the end of 2012, you know what I said? Everybody take your money back. I'm not going to trade your money anymore because I can't deal with these people anymore. Did you realize there's only basically 3 brokers left in the U.S.? That's how overregulated the Forex industry is. Now, I'm not saying that every industry is overregulated, but I just do want to point out there are good regulations and there are bad regulations. And but businesses love less regulation. You see, for me to comply with all of the regulation that I was faced with, very expensive. Very expensive. And I'm sure at some point, then they kept changing the rules so quickly and adding so many regulations. As soon as you jump through one hoop, they make you jump through another one. And after a while, you just give up. You say, forget it. Well, imagine this. The cost of complying with regulations is going to drop dramatically because there's going to be fewer regulations. So the cost to companies will drop. What does that do to the bottom line of those companies? Profits will rise. Profits rise. They're probably going to hire more people. And you're going to see wages begin to rise more quickly. In addition to that, corporate tax is the same thing. Right? The corporate tax rate in the U.S. is approximately 35%. One of the highest in the world, if not the highest in the world. If that drops to 20%, guess what? That's 15% that goes right into the company's pockets. Now, I'm not saying they might just pass that on to shareholders, they might just keep it, but it could be also, say, let's take this money and make more money with it, right? And next thing you know, they're hiring and wages are going up. So I'm not saying it's right or wrong. I'm just saying this is what I think is going to happen. So the last year of wages probably is going to look very different in my mind than the next. I'm not saying you're wrong. I'm just telling you, and Sandy, I really appreciate your input. I'm not saying you're wrong at all. I'm just telling you this is how I see it. And guess what? I'm not always right. So anyway, it's a fair question and it's a good conversation. So why is dollar going down? I don't know. And you got me on that one, right? Got to be honest with you. This is, maybe they just bought the rumor, sold the news. I don't know. But it doesn't make sense to me from that standpoint. Okay, so we looked at the dollar. We looked at oil. We looked at gold. If you look at silver, take a peek at silver. And silver is looking even better than gold, quite frankly. I mean, can we put them side by side here? I don't want to risk losing it. But if we went gold, right, at GC, gold looks pretty good. Silver looks just as good, if not better. Right? Pretty much the same chart. Copper's very interesting to me because of the way it popped out of here on high volume, and it's beginning to pull back. Why do they change the rules so much in the U.S.? Forex was completely unregulated before 2010, so it was the Wild West. Quite frankly, it needed regulation. You had all kinds of, anybody could have opened a broker. I mean, we could have opened a broker. Everybody in this room could have said, let's open a broker and we'll base it in the Cayman Islands, right? And we won't pay any taxes and we can do business in the U.S. because the U.S. Forex wasn't regulated. They didn't know what to do with us. So it was the Wild West, and there were some bad eggs who needed to leave. And they were driven out, but they threw out the good with the bad, too. There were some very good companies that also left that said, we just don't want to be here anymore because it's too tough. And so they took this thing, the pendulum was way over to one side, and then it swung all the way over to the other side. And really, it belongs in the middle. So now Dodd-Frank, this all started with Dodd-Frank in 2010. Now Trump's talking about dismantling Dodd-Frank, so the pendulum is probably going to swing the other way now. But not all the way back to where it's the Wild West again. I don't think anybody wants that. The good spot's in the middle. Okay, can we take a look at dollar CAD? Yes, we can. Before we do, though, let's take a quick peek back at our little trade. If you missed it during the first session, we set up a trade on Aussie yen, and it's going pretty well. Last I looked, so let's take a peek, and you can see it's really quiet, but it's been creeping toward the first target. Green is the entry, red is the stop, and blue is the first target, and blue is also the second target. And this was a trade set up. If you missed the first session, if you want to understand why I did it this way, just go back and look at it. We'll look at dollar CAD in just a minute, but I wanted to show you something here first. Because there's a methodology that could be applied to this for moving the stop. And it's called two-bar Charlie. Has anybody here ever heard of two-bar Charlie? Just give me a Y or an N. Because I'm going to teach it to you right now. Take you 2 minutes. I got a yes from Henley and a no from Sandy. So, and other folks have refrained from commenting. But here's how it works. 2-bar Charlie got another no. So most of you never heard of it, right? Here's how it works. You take the 2 most recently closed candles. So when the chart looked like this, these were the 2 most recently closed candles. Your stop would go under the low of the lower of the 2 candles. Both candles would have to be closed in order to do this. Why? Because if this candle's still open, then you don't know what the low is. It could turn around and and the low could be different, right? So the stop is under the lower of the 2 right now. Now another candle closes. We go to the lower of the 2 candles. Just under the lower of the 2 candles, right there. So we could move the stop up, and really at that point you're taking virtually no risk. Another candle closes. Now, out of the 2 most recently closed candles, which is the lower low, it's this guy here. So I could move it up a little bit more, right? And just keep it under the low of the 2 most recently closed candles. Here we go again. The 2 most recently closed candles, this is still the low. I can't move the stop. And that's where we are now. So does everybody understand how that works? You go to the low of the 2 most recently closed candles. It's called 2-bar Charlie. Well, we should call it 2-candle Charlie maybe, right? I'll do it again, and then we'll take a look at dollar CAD, okay? So we're gonna run. We've still got about 8 minutes left in the session. Plenty of time. If you haven't noticed, the sessions tend to start a little bit late and end a little bit late. That's because of people have difficulty getting in the room. So that we're going to run past 9:30. Don't worry. Here are the 2 most recently closed candles. You go below the low of the 2 most recently closed. There's your stop. Another candle closes. Whoops. And now it's your job to calculate which is the low of the 2 most recently closed candle. Looks like it's this one here, right? So we can bring the stop up to just under the low of this candle. Bring the stop up to here. Another candle closes. Which is the low, the lower low of the 2? It's this one, isn't it? It's this one. We can bring the stop up a little bit more, right? But we can never lower it. You can never lower a stop, no matter what happens. If it gets hit, it gets hit, but you can't lower it. You can only raise it. If you're long. If you're short, the opposite is true. You can only lower it. Another candle. This is obviously not a closed candle, but if it were, this would be the lower of the 2, and the stop would stay right where it is. And that's 2-bar Charlie. Now this is an hourly chart, so this candle is going to close in 31 minutes. So what I could do, if I'm using a 2-bar Charlie method, I could simply walk away and come back in 31 minutes, and I will either be stopped out, or I might have an opportunity to raise the stop. Probably not, though. Probably not, because this will almost certainly still be the lower low of the 2. If this one makes a lower low, what's going to happen? I'll be stopped. I'll be stopped with like a 2-pip loss. Right? And that's no big deal. Okay, so that's called 2-bar Charlie. I'm not necessarily using that, but I want you to know what it is, because that's something you could use in your own trading. Very valuable tool. And it doesn't take no secret indicators, right? Just easy peasy. Let's go to dollar CAD. And dollar CAD's interesting. This looks to me, like from the daily, this looks like a gigantic descending triangle. All right, so big picture first, then we'll work our way down. High, lower high, lower high. And the lows, well, you could pretty much just drop a line in here. That looks like a big topping pattern. You could say it's a descending triangle. You could call it a rounded top. Just remember that Canada's economy is tied very closely to the U.S. economy. If the U.S. economy does improve, then Canada's economy certainly will too, because about 75% of Canada's exports go to the U.S. So if business becomes good here in the U.S., we're going to need more stuff, and Canada's right next door. Lumber, oil, all kinds of base metals like nickel, silver. We can get tons and tons of that. Copper. We can get tons and tons of that stuff from Canada. Oil, right? They're even going to build a pipeline maybe to bring oil in from Canada. So anyway, U.S. economy being strong doesn't necessarily hurt Canada is what I'm trying to explain. It's not a bad thing at all. Okay? It's kind of a massive, massive play, though, on this time frame. And look at that line. That line's basically 130. Huge round number. Huge. To me, it's possible that the entire tenor of this trade changes under 130. Price almost certainly has to go there just to find stops. There's going to be so many orders at 130. They've already touched it multiple times. So maybe that's, but it's been a week. There's probably more orders forming there. I would say this: rallies away from 130 are shorting opportunities. And this is probably the one currency that's looking pretty good against the dollar right now, Aussie and Canada. Both commodity currencies, right? Aussie and Canada. Both strong, both commodity currencies. We said earlier that Aussie was crushing everything in sight. Aussie CAD, Aussie is even stronger than Canada. So Aussie's still the champ, but Canada actually holding up pretty well against the dollar. Canada holding up, I'm sure, pretty well against the euro. Okay, maybe not as strong as I thought, but still pretty strong. I'd be looking to short dollar CAD on rallies above 130. I'd be looking to short rallies above 130. That's how I would play it if I had to play it. But I don't see it as really that compelling. Could be an excellent trade, though. But I don't see it as compelling in the short term. I think long term it's compelling. Okay, gang, that's going to wrap it up for this session. Thanks, everybody, for your participation. You make this room what it is. It's your questions, your comments. I apologize if I occasionally missed a question or comment, but it's a great room. It's high-level discussion. It's not what is a pip. It's good stuff, and I'm really grateful for your participation. So let's do it again. I'll be back next week. Okay? So Monday, we'll do it again. Everybody have a fantastic day, and I'll talk to you soon.